Well, good afternoon, everybody, and we're glad that you can join us today for our seminar focused on getting your financial house in order post-COVID-19. I'm Lee Boss, Managing Director with the Mercadien Group, and I have with me here today Michael Wardy, CFP, who is a Regional Director with Source Advisors. Just a little bit of background on both of ourselves. Myself, I'm a CPA and an MBA, Managing Director with Mercadien. For those of you who do not know about Mercadien, we're actually been in business as a firm for over 55 years, serving the unique needs of businesses, not-for-profit organizations, government agencies, banks, and individuals. We provide a diverse host of services: tax planning, tax compliance, attestation services, including audits, reviews, compilations, and a host of advisory services, which have really been an area of focus over the past several years. A lot of areas such as exit and succession planning for business owners, assisting with bank financing, refinancing, capital raise, and strategic planning, to name a few. With me is Michael Wardy, a Regional Director with Source Advisors. Michael, do you want to say a few words about Source Advisors and yourself as we get started?
Absolutely. Thank you, Lee, and thank you everyone for joining today. We appreciate the opportunity. As Lee had mentioned, my name is Michael Wardy. I'm a Regional Director and Certified Financial Planner here at Source Advisors. And for over 37 years, CPAs and our clients have relied on our insight, knowledge, and professional guidance to help them maximize cash flow through federal and state tax incentive programs. So with that being said, my daughter, who for the past 15 years asked me what I do, and she still didn't quite get it until just this past year. She said the best way to explain, or for me to understand it, she said, is basically paying taxes stinks and you make it stink less. I thought that hits the nail on the head. Thank you.
So, that's great.
Thank you. Thank you again, Lee.
Great introduction, Michael, and we agree as well. Goal obviously is to try to minimize taxes to the extent possible, defer taxes to the extent possible, and obviously maximize financial results for the businesses that we work with. So a couple things just want to go through. This is actually a series of seminars that we're planning. We actually sent out a survey earlier this summer. Ashley Webb, who is assisting us on this presentation today, put together a great survey, and we sent it out to our contacts and business owners and asking them what the big impact of COVID-19 has been on their business and information that they're looking to get. And these were some of the webinar topics that were identified through that survey, as well as working with our clients, that we know there's more information that can be provided out there. So one is identifying and managing risk in a post-COVID environment. So that'll be upcoming. Preparing your business for a succession or a sale in a post-COVID environment. And as Mercadien, we've done some webinars that you can find on our website about the M&A environment in this world that we're living today. Also creating and managing a technology environment to support working remotely, which is a hot topic, and we'll touch a little bit on that topic as well as these other topics today. And then lastly, HR challenges and opportunities within a remote workforce. We'll also be having various subject matter experts present with us as we go through this journey. And we may identify additional topics as we get more feedback from you, as well as others within our client base and in the community in broad. It's interesting, this topic, getting your financial house in order post-COVID-19. Many of you are probably asking, well, post-COVID, we're not here yet, right? We're still in this long journey together, which seems like, initially we thought this would be maybe a few months, and now we're several months into it, and we're still not quite sure how this will ultimately evolve and end up. But we think this is a timely presentation to start talking about the lessons that we've all learned and sharing those best practices to help us prepare for future COVID-related events. So that's really the thought process behind it. For those of you that are CPAs and you're wishing to get CPE credits, we actually will be providing CPE credits today. Just a couple housekeeping items to be aware of. First, we will be sending you some polling questions go through this seminar, so you'll see those flash up on your screen. There'll probably be about 3 to 5 of those that we'll have. That's a requirement to issue CPE credits. You just have to respond to those. And then the other thing we'll be doing at the end of this, we'll be sending a survey and evaluation for you to fill out and return back to us. Once you return it, we'll then issue your CPE certificates. So the agenda today, go through this briefly. And we're going to have about an hour and 15 minutes that we're going to cover in course material, and then we're going to open it up to any Q&A. And as you go through this presentation, or we go through this presentation, if you have any questions, you can actually post those on the bottom. There's a chat icon, and put your questions in there, and we'll address those as we get either through the presentation or as we get to the end of the presentation. A lot of those questions may actually be addressed as we go through, so we'll likely save a lot of those towards the end. Just another item I wanted to note is that this is not a seminar on the PPP or specific tax provisions related to the CARES Act, like the the employer portion of a payroll deferral or the the jobs tax credit. We're going to be talking about some economic incentive programs, primarily related to tax incentive strategies, negotiated incentives. So I just wanted to make everybody aware of that to set the expectation as we go into today's presentation. So agenda, we're going to talk about how to produce accurate financial reports and projections, forecast, and we're going to have a little bit of a slight twist to this. So we're not going to get into all the nitty gritties of the debits and the credits and the reconciliations and all the things that us accountants really like to talk about to make sure that your financial records are accurate. But so we're going to go a little bit of a different twist. Understanding key financial drivers and metrics we're going to cover, how to be flexible and adapt in a changing environment. I think that's one of the areas that we've all learned over the past several months is how to be more flexible and how to adapt to this new world. And then Michael's going to take us through the economic incentive programs and tax strategies and things that source advisors have been working on, advising their clients and bringing value to their clients, and then open it up for some Q&A. So how to produce accurate financial reports and projections and forecasts. And with this, I'm referring to financial statements. These are typically things that a company will look at on a monthly basis or on a quarterly basis, but also will include things like projections, revenue projections, cash flow projections, forecasts of cash flow, and so forth. So it's much more broader than just your traditional financial statement package that we'd like to think about. And before we get into this, it's really important that we begin with the why. And the why is why are we using financial statements? What are they helping us to do? And fundamentally, they're helping us to make business decisions and take corrective action and monitor how we're doing against results. And it's interesting because it became rather clear as COVID was becoming a major disruption that many businesses scrambled to get their arms around the business financial picture. They're really trying to get a handle on what type of impact COVID would have on revenue projections, sales to customers, what impact that would have to their operations, also understanding what type of additional costs they may have to incur related to things such as PPE, cleaning, safety, perhaps re-engineering the way they do business. A good example of that would be restaurants, where obviously they had a lot of in restaurant business, and now they're doing a lot of takeout and things like that. So what was the impact to maybe purchasing new equipment, new terminals, web-based platforms that do order intake and so forth. So companies were really scrambling to understand COVID and what that meant for their business. And the big aspect too was risk. What's at risk as far as receivables and collectability from their customers. And businesses were asking questions, just how long could we sustain this? Looking at their profits and loss as well as cash flow projections. And many businesses were not ready for this type of a major disruption. They may have had some type of financial information in place, probably had a controller or a bookkeeper that would process transactions and pay bills, Maybe the business owner was getting a profit and loss statement in some way, but really understanding things like, well, what type of cash flow projections and forecasts do we have? How long could we sustain this type of market disruption? Those are things that were never really factored into their analysis in the past. So I think it's really important as we talk about producing accurate financial reports, understanding why, why are these important? And fundamentally, that's a question that each business owner needs to ask themselves and have an answer to. But I would propose that the why is that it's going to help you run a better business. It's going to help you identify when you're on target or when you're off target, and it's going to help you manage your resources. So that's really the first item that's fundamental, is understanding why. What, as a business owner, are you trying to get out of by having good financial information? The next step is to identify what information is useful to you. So often we find that financial statements have a ton of information. A lot of that information, while it's helpful, it may not necessarily be useful in the managing of the business. So identifying for you what's the most useful information, maybe that's revenue by segment. Maybe that's revenue growth year over year by segment. Could be payroll costs if you're intensive in payroll related costs, or manufacturing costs if that's something that you're keeping a close eye on as far as your manufacturing and gross margin. So really identify the key financial information that's useful. Developing the systems to gather the information. And I'm not talking just about general ledger packages and things like that. As I think about developing systems, I'm thinking about systems like even pipeline. So what type of pipeline do you have of sales to customers or contracts or work that's been sold but not yet delivered? So developing systems that's broader than just your traditional financial statement packages, and getting information on that. Often this entails collaboration with, say, project managers or sales representatives within your business. But having a system that you can gather information, again, understanding the why and what information is useful for you. And then sharing that information, and a lot of times businesses will kind of keep that close to the vest, but there's information that actually can be provided to, say, your managers or your divisional leaders or all of your employees on certain key financial metrics that is helpful to help gain insight into the business, as well as alignment with the business and their goals that you're trying to accomplish. Often we find that when certain financial information is shared within certain levels of the business, that actually helps create team spirit and better overall alignment to your strategic goals. And then we just continue to refine. So some of our clients have things such as monthly management meetings, where they get the divisional or management team from within the business to come together on a monthly basis and actually review that financial package. If that is a profit and loss statement by division, if that's a cash flow forecast, if that's budget versus actual, and get their fingerprints on it so that they own those financial results and they understand how the business is being monitored and evaluated based on that. So that's really important as well. So the next piece is to try to summarize this, is really understanding your key financial drivers and metrics. So as I mentioned, there's a lot of financial information out there, and I think it's really important that business owners really hone in on what's key and important to them. And what we like to look at is identifying the key financial drivers. And these could be things such as number of services performed, number of customers, number of products shipped, sales by segment, understanding what really drives your revenue in your business. And a lot of times it's not, say, dollars of revenue, but it's more the metrics such as I mentioned. And then understanding the cost drivers. So that could be employee headcount, it could be labor hours, it could be unit of materials used in the business, but understand what really drives your costs. And that really helps you put together what I'd call your financial health metrics. So, and ultimately getting to where I think the best in class are able to utilize this dashboard approach, where they're able to actually capture this information and information that's useful in a dashboard view to help. But some of the key financial metrics that we've seen that may be tracked, revenue growth, could be revenue growth by segment, profit margin by segment or division. Utilization is actually another big one that we see for those that are in service businesses. So how productive are your employees? How utilized are those resources? Tracking utilization statistics. And then things like days sales outstanding, accounts receivable aging by category is really critical to understand how you're doing. So you serviced the business, you sold the business, but now you need to collect that. So having a process in place where you can actively track and monitor and take corrective action to make sure that receivables on the street are getting paid. That was really critical, especially on the early stages of COVID when businesses were really struggling for cash. And then I mentioned these dashboards, I think is really critical. So some companies will, capture key financial statistics and these financial drivers and metrics in an Excel workbook. More sophisticated approaches could be with Tableau or Power BI or other type of BI type software that's out there. But really the goal is to give yourself a sense, instead of having all this real detailed information, really identifying what the key financial information is that will help you evaluate and monitor the business. So a couple of things we've seen on getting your financial house in order that I think is really critical as we go through here. And these are some of the lessons that we've seen, or the best practices that we've seen with our clients. There were many businesses that we're aware of that never had an available line of credit or other type of financing sources lined up. And typically when we would speak to them and encourage them to get a line of credit established for their business, the common feedback was, well, we don't need it. We're cash doing fine. We're profitable. We don't really foresee any need for it. Why do I have to go through the bother? And our answer was always, well, you never know when you may hit a bump in the road or have a need for a credit facility. So it doesn't hurt to actually have one. It's actually prudent business practice. And that was pretty true what we saw on COVID for many businesses, that in the time of a pandemic is not the time to try to get a line of credit established and in place. The banks were actually incredibly busy with initially the PPP loans and other type of helping clients with their financing, their existing clients. So it was very prudent to have a line of credit established before the pandemic. And it's actually best practices to have multiple relationships with banks, or at least have some different relationships. And for example, we're a good source because we have a number of clients, obviously, that have lines of credits, and we know a number of different banking relationships. So also leverage your CPA firm, other advisors for the relationships that they may have with other banks, which is very helpful. But it's actually one thing that I advise clients also to have is have information readily available as part of your monthly close process, information that you would likely need to provide to a bank. Even if you have the line of credit, but you may not be drawing down upon it, but have information such as you may need shareholders' personal financial statements, have that prepared on an annual basis, borrowing certificates, accounts receivable, aging details, obviously financial statements, and audited financial statements are usually the best as far as securing the biggest line of credit that is available. The other thing that I think is really critical is establishing your team of advisors. It's kind of the same concept is often you say, well, I don't need a legal counsel. I don't need, a banker right now. But having a team of advisors and have that established now helps you when you have that time of need. So these team of advisors typically would be legal counsel, risk management professionals, your bankers, CPA, and wealth managers would be kind of your core team of advisors. And there may also be others from different professions, but having that team of advisors established now. And what I've seen as a best practice is where a company will actually have that team of advisors come in and meet all together. Now, obviously in this environment, we're doing that through Zoom or Teams or GoToMeeting, but actually have all those advisors come together and have the business provide an overview of the business, their strategic plan, what their outlook is, and what their goals they're trying to accomplish. This helps ensure that all the advisors are on the same page as far as what the objectives are, what your objectives are. And then also helps them kind of work together and establish that relationship. So that's something that I've seen with our clients that really goes a long way, helps to create that cohesive team. Another area, and we've seen this in particular in the estate planning area, was when COVID hit, there was a lot of clients that said, well, I need to look at my wills and my estate planning, durable power of attorneys, medical directives, things of that nature. These are things that we all should have had in place and should have been considering before COVID, but I think COVID really put those to the forefront as business owners and individuals alike were concerned about the health pandemic that we're facing. So it really brought to the forefront about having a process in place that you do when you go through estate planning. Estate planning checkups are a great idea, where maybe every few years you sit down with your advisors and you go through your estate and you make sure that all the documents are properly titled, beneficiary designations are made, and so forth, and look whether you've done the right estate planning with different vehicles. Also in that light, it is important for businesses to go through a succession planning exercise. And often businesses, it's never too early to start succession and exit planning for a business, thinking about where the business will ultimately transfer, either to a third party in a third party sale, or perhaps there's a family member that the business will succeed to, or perhaps there's a key executive or a key executive group that may ultimately purchase the business. But starting that process early, where you're identifying as the business owner what your objectives are with that business. So understanding what's your time horizon, what do you ultimately want to accomplish with the business? Would you like to transfer it to a family member, key leadership, or is it something that you're trying to maximize deal value, where maybe a third party sale is more likely for you? But identifying kind of where you ultimately want to be and where you're at today, and what are all those gaps that have to be filled in between, and then working that plan to fill those gaps. So many businesses did that. That's what I would refer to as an orderly succession plan. But they may not have been focused on what we call the emergency succession plan, which is, I would argue, more critical than the orderly succession plan. So the emergency succession plan kind of goes through a process. If the CEO isn't here tomorrow, if the chief financial officer is not here tomorrow, who are the positions, or what is the strategy to basically fill those shoes? So that's another key thing that we always want to have businesses focusing on, is both that orderly and the emergency. And this is something ideally that should be done on an annual basis, or at least checked up on an annual basis as things change within the business. So if there ever is an emergency, you can just pull out that plan and you're ready to go. So really a key thing, that what I would say, getting that financial house in order, one of the key elements. Electronic records is another big area. Obviously, it makes sense now why electronic records are so critical as we've, gotten out of this paper environment that we're in today. But it's really important from a number of standpoints. Typically, when you can eliminate the paper in a process, it makes that process that much more efficient. It allows you to actually get that information much quicker, in an electronic format. And in today's environment, it allows us to actually work remotely and service our customers and clients remotely in that type of setting. So having electronic records, if that's something that as a business owner you haven't fully done, it's definitely an area that you need to continue that evolution to get your financial house in order. And that kind of ties into the next area, which is getting nimble information systems in place. And you might ask, well, what do you mean by nimble? And the best way to explain it, or the best way to look at it, is premise-based type technology services, where those technology services and servers and so forth were actually resident within your business. So you may have a server room, you may have multiple servers, you may have file servers, mail servers, and so forth. And those are all servers that basically the business has to maintain in one way or shape or form. You may have an internal technology specialist or employee that services those and maintains those servers, or you may have an outside third party come in and maintain that system. Versus what the future is, and it's already here, it's been here for a while, is cloud-based services. So having server space that's out in the cloud, where you basically rent a portion of a server, having your key applications also in the cloud. For example, most accounting firms now have all their tax preparation software they use is actually not saved on premise, it's actually out in the cloud. And the CPA firms personnel are going to the web, accessing that site directly, preparing all the tax returns directly on that site, and processing them all directly on that site. So that's what I would consider premise versus cloud-based. And being more cloud-based allows you to be more nimble in many respects, is that you don't have all this kind of overhead and maintenance to maintain your own infrastructure and servers. The downside is typically with a cloud-based service, you're actually paying more because you're paying somebody to actually maintain that for you. One would argue that, well, you actually pay for more in a premise-based because you have to pay for the technology support or your own internal personnel. So having nimble information systems, that's really critical, and one of the areas that we've seen clients of ours be able to capitalize on, where they had really good systems, they could just kind of flip the switch, versus those that were kind of still maybe on that on-premise, or it was very challenging for them to kind of work in this remote environment. And then lastly, the disaster recovery and contingency planning. And it ties a bit into the succession planning that I spoke about previously, that emergency component of it. And this was a real hot topic back when we had Superstorm Sandy here on the East Coast. As an example, it made everyone realize how important it was to have some disaster planning, contingency planning. If you cannot get into your business, how can you keep the business afloat? How can you keep business in operation? So it's another exercise tied into the succession planning from an emergency standpoint. But here we're really talking more about your processes, your methods of producing, of accessing your customers, accessing information, accessing your process is a broader discussion topic than just the emergency succession planning that we talked about before, but really critical. And I think COVID-19 was kind of opened our eyes to this. We always thought, well, there could be a flood, there could be a fire, we could have some natural disaster, natural events like hurricanes and earthquakes and things like that. But I think, frankly, most of us didn't see the pandemic, a health pandemic, on that list. So really the thought is to actually have, as part of this disaster recovery and contingency planning, and it is a plan, it's a process that you'll actually go through to think about all these different events that could occur and develop a plan around that. How are you going to respond to it and still keep the business running, even though you may not be able to open the doors, the physical doors to the business? So it really highlights this area of how to be flexible and how do you adapt in a changing environment. And unfortunately, we don't always have the answers into what the future is going to have. So it really entails a deep inspection into how you specifically do things as a business owner and really understanding where the puck is headed. And a big component of this involves your culture. So there are some businesses that seem to do it very well. They can be flexible, they can adapt, they're nimble, they move in different directions, they pivot. And then there's other businesses that seem like, and we probably all know them, where it's very difficult. It's like moving the Titanic, basically. They see the glacier out there, but they just can't move. And I think this really involves and highlights this issue of culture. What's the culture of the business? Is the culture one that's minded where it can be flexible and adaptable and pivot, or is it one where it's going to be very static? So that's something to keep in mind as we talk about being flexible and adaptable in this environment. But it really starts with, in my opinion, strategic planning. As part of your strategic plan, and businesses are doing this now, is they're asking themselves, how can we adapt? How can we pivot? What are some things that we can do differently? And think about that from a strategic standpoint, involving, maybe not just the shareholders, but also your other key leadership to get their fingerprints on it. And thinking about really different ways that we can do business. And it's interesting because I think we've all learned a lot of lessons through COVID, things that maybe challenge the past paradigm on this thinking. Firstly is that consumer behavior will change. And I think that's very evident based on when we look out there in the marketplace, how consumers have changed their behavior. So everybody used to eat in restaurants, and we understood we can't eat in restaurants, so we can do takeout, we can go to the grocery market, we can do more cooking outside and things like that. So consumer behavior will modify, adapt, and change. So that's one thing that we learned that's interesting. The other one is that employees can work at home. And I think while many of us still struggle with that for a number of reasons, I think it's been proven that we can actually work at home with the right systems, with the right setup, and so forth. The other thing is the old thought was that you had to have face-to-face meetings. And actually, Michael and I were talking before our presentation today about how we used to give in-person presentations and the difference between in-person presentations and now the presentations that we're doing like today through Zoom or Teams or GoToMeeting. And the reality is that the face-to-face meetings are not always necessary. I think there's a time and a place for them for sure, but I think we've all learned that you can actually conduct and be just as productive or maybe even more productive in a virtual environment. So that's one of the real takeaways of business being different. And I think the other thing that we learned through this process, and I guess there's many, we can all talk about the many different things that we learned, but that employees need more flexibility. So I think that's really a key thing in this work from home remote environment, is that we all have to be more flexible, and our employees also need more flexibility as far as how they do things. So that was actually one of the topics that came out through the survey rather loud and clear, was that we need to talk more about HR related matters, working in this remote environment with our employees. There's also the whole issue about legality and legal related issues, in particular as it relates to COVID and health concerns. So it's an area that we're going to continue to give some more guidance on and get a panelists together that will talk more about that. So that really is, I'll hand it off to Michael. Actually, I think we're a little bit ahead of time right now, but I'll hand it off to Michael to talk about his part of the segment.
Great. Thank you, Lee. Thank you for that information. So when I was listening to Lee present and talk about the strategic planning and the preparing for that, the other part of planning and preparing is from an incentive standpoint and a cash flow standpoint, and making sure that wherever there are incentives available to a company, that they're captured first, that they're known, and when appropriate, when available, capturing those and maximizing those. And the research and development tax credit continues to be one of the most lucrative incentive programs available to businesses, both on a federal side and for certain states on a state side as well. And over the past several years, even more recent, over the past several months, since this whole shifting of how businesses are run, a lot of businesses are reinventing themselves, and they've expanded and they've shifted and they've changed their industry specializations, their customer focus, their client focus, their approach. All of that time spent can qualify. And I'll get into how and why it could in a couple seconds. When the research and development tax credit was first introduced, the intent was really to try and keep higher level jobs, technical jobs, engineering, software type jobs here in the country. And in theory, great idea. However, there were so many limitations and restrictions. The R&D tax credit was not being really utilized by the companies that it was intended to incentivize. So, which was really the small to mid-sized businesses, which are the largest employers compared to the larger businesses. Over the years, there's been an expansion of the definition of what qualifies for the research and development tax credit. More importantly, an easing of the documentation requirements. Now, if your company has new products, new processes, improvements to those products or processes, if you're bidding on new jobs or coming up with ways to create efficiencies within your organization, you may have qualified research activities. Keep in mind, the R&D tax credit is a project-based credit, meaning that it's based on the work that's being done in a given year on a specific activity. And in order for that to qualify, it needs to meet the definition of the research and development tax credit, the 4-part test. The 4-part test, and I just want to put this out for everybody. When you get your survey, if you want a sheet describing in more details about the 4-part test, just make a note and we'll email that to you as well. The 4-part test, again, you tie those 4 parts to a specific project. If you can answer yes to each of the questions, therein lies R&D. So the first question of the 4-part test, is it technological in nature? And what we're looking at there, engineering type activities, software development, chemistry, biology, any of the hard sciences. That's where R&D first starts in terms of does it qualify or not. We had a company that we spoke with, they were clients and sold their business, and they bid on a job and they said that there's probably not any R&D. We were just making a red switch as an automobile parts manufacturer. It's a red switch for GM. We thought, okay, it's a red switch. How hard could that be? They said it took them 6 months to get to the right color red of that switch. It was the constant blending and the constant testing of that color, sending out the prototypes and the samples out to GM. Does this qualify? Does this work? Back and forth. That's where the R&D started to come in. So the first question, is it technological in nature? The second question, is it a permitted purpose? And what we're looking at there, is it a new product, a new process, or an improvement to a product or a process? And when we talk about new, it's something that's new to you as a company. It does not need to and no longer needs to be brand new to the world, never before seen, just something that you haven't done before. We have a lot of manufacturing clients that will bid on new products that they haven't done before for their customers. Each one of those, if it, again, meets the 4-part test, but if it's new to them, we can start looking deeper into whether it qualifies or not. So technological in nature, second question, permitted purpose, new product or new process, or improvements on those products or processes. The third and the fourth are going to go hand in hand. So the third question, was there any uncertainty? And the fourth question, was there a process of experimentation? So when we talk about uncertainty, we equate that to, we know what our end vision is, but we're not quite sure how to get there. We have some ideas, but we're going to have to go through different iterations, different samples, different prototypes. Each time we do that, we know we have uncertainty. On manufacturing, we see that a lot when they're bidding on new products or they're building a new tool for a customer. On software, there's always uncertainty. And for the attendees today, they're in software and technology, they're probably nodding their head saying there is never a clear-cut path to building anything in software and technology. That fourth part that I mentioned, process of experimentation, that's the trial and errors, the prototypes, the first runs, first articles. That's what we're referring to there. So let's go through it again. Technological nature, permitted purpose, uncertainty, and a process of experimentation. R&D starts at the point that you first come up with an idea, or you go out and you bid or talk with a customer or a client. Again, we have a manufacturer that the CEO would meet with various customers. Not anymore, it's all virtual. But when they would sit down, they would say, hey, we can make that part and we can make it even better for you. And here's what I mean. Then they would take that and go to their engineering team. The engineering team would cringe and say, we have no idea how we're going to do this. And the CEO would say, that's fine, figure it out and get it done. And they would consistently. R&D started at that point where the CEO met with the customer. And it included anybody and everybody involved in the development or improvement of a product or a process, all the way through to commercial production. Once you figured out all the questions, there is no more R&D. When we talk about who we include in the research and development tax credit, or what the costs are related to this, again, it includes anybody and everybody involved in the development or improvement of a product or process. And we include box 1, other W-2 wages. The other components, any supplies or materials that are includable in that development or product of a development or improvement of a product or a process. So any prototypes, any tools or dies, mold fixtures that you build in developing this, we can include those costs. The third component, the third area of costs that can be included is going to be any outside contractors that you bring in to help with the development or improvement of product or process. We can include 65% of their costs. Again, box one of the W-2 wages, including anybody and everybody involved in the development or improvement of a product or process. Any supplies or materials, and any outside contractors. We can include all those. We generally will get a question of, okay, this sounds great. What does it all mean? On the federal level, the credit works out through the formulas, works out to be about 6.5% to 7% credit on your qualified research expenses. So every $1 million that you spend, you're looking at about a $65,000 to $70,000 federal tax credit. Keep in mind, this is a dollar for dollar credit off of tax available for taxes owed or paid. Where this is becoming so important for companies is because of what's been going on with 2020 and limited cash flow for some of our clients. They're now going back and looking at prior years. They're looking at the work that they did from 2017, 18, even 19. And the reason that they're doing that is before they didn't have time. They were busy. Business was booming for them. They were working 3 shifts, 7 days a week. They didn't have the time or the resources to dedicate. Unfortunately, with the shifts that have been going on, they now have time to take a look at it. And fortunately, they have the availability and the accessibility to do that. So we can look at work that was done from 17, 18, and 19. That's on the federal side. On the state side, as I mentioned earlier, there are several states that have the research and development tax credit available. States like New Jersey, there's a 10% credit on increased qualified research expenses. For Arizona, there's also a significant opportunity. Massachusetts is increasing their research and development tax credit starting in 2021. It'll increase by 25%. Unfortunately, in New York, the research and development tax credit, which was a great program, expired back in 2012. They had launched it and it was set up fairly liberally to the point where people were taking advantage of it that should not have been taking advantage of it. So that's no longer available. There are other incentives out there that we will talk about in a second. The next area that we're going to talk about is cost segregation. Cost segregation is all about increasing your cash flow from your building, whether you're buying, building, or leasing it, all through accelerated depreciation. It's often an area that people don't really think about, or even worse, they think it's too difficult to do. What a cost segregation does is it takes apart your building and property virtually, not physically, and reclassifies the various components into shorter life property. By placing these components into shorter depreciable lives, you're increasing your immediate depreciation, thus reducing your taxable income. Why this is important right now is because let's say you bought a building in 2020. If you were to do a cost segregation, you may increase your tax loss for 2020. However, you can take that loss and carry it back 5 years, which means that if you pay taxes in 2015 or 2016, you'll be able to get that money back. This is an important consideration for those that are reviewing cash flow strategies. We often get, what does a cost segregation mean? How does it work? Give me some numbers. And we get that statement a lot. Give me some numbers. Quick and easy way to understand what a cost segregation can bring to you, we use the simple phrase 3, 2, 1. You can expect to increase your cash flow between $30,000 to $200,000 for every $1 million you spend. Why the big spread? It really depends on what the activities that are being performed within the building. So $1 million, where $1 million warehouse probably is closer to that $30,000 in additional cash flow, whereas $1 million spent in the tenant improvement for an office building may be closer to that $200,000. The last area that we want to touch on is negotiated and discretionary incentives. Many businesses do not take full advantage of this area. And when you're expanding or hiring or looking to move locations, states and counties are fighting to bring in new business, and they're willing to pay for it. For example, we work with a client that was moving their location. They were moving from Oregon. They wanted to come out to the East Coast. And they negotiated a package that they did this themselves originally. And they thought it was a great package that they were offered. It was for $70,000 by the municipality where they were moving to, the county they were moving to. They considered that a success. Our incentives team got involved, and we were able to help them renegotiate that package, and it increased it to just over $620,000. Why that happened is because to have a specialist in this area brings a lot of value, because they know what to do, how to do it, and how to approach it the right way. Not that 70,000 wasn't a lot, it is, but compared to the 620,000, quite a difference. While every state wants your business, they're struggling to generate the resources to incentivize businesses to come in. For example, unfortunately, New Jersey, which is from the incentives group that I talked to, the practitioners, they said that they're in a state of flux, and incentives have expired. They actually expired back in June of 2019. Hopefully they'll start to turn around and we'll start to see some incentives come back in New Jersey. Arizona has a few ranging from the quality jobs tax credit to the quality facilities tax credit, which is a refundable tax credit. And those are the areas that we look at for each of our clients, is refundable credits available for training, which Arizona also has for job training. They have incentives for that. Pennsylvania has a discretionary grant that's called the Pennsylvania First Program. You may have heard of it. Unfortunately, the state is experiencing a deficit and the program is canceled until further notice. But while that one may not be available, there are other ones that are available, like the Keystone Opportunity Zone credit, which is for businesses located within those specific zones. For New York, the Excelsior program, job program, is available. And there's a whole list of different incentive programs that are available in New York as well that may not be as well known or publicized. It takes somebody to sit down and go through and vet out not only what's available, but how to find those and how to pursue those. Again, each state has its own incentive plan available, and it takes somebody to dig in deep to understand what the best incentive package is for you as a company. Again, if you're looking to expand, hire, or move. Thank you again for this opportunity to share some insight and some strategies with everybody. Lee, should we open up for questions?
Yeah, Michael, I just wanted to one point on things that you said that's interesting is, it's really, when we talk about getting your financial house in order, I think it really highlights that one is obviously having good financial information, understanding what you're looking to accomplish by monitoring, managing your business to drive to results. There were some kind of low-hanging things that I went through about, making sure you have an available line of credit set up, even though you may not have to draw down on it, but have it ready, have it available. Other things about emergency and succession planning. But I think your point really highlights that there's probably a ton of these things. I mean, R&D, cost seg, negotiated, what you refer to it,
negotiated discretionary incentives.
Yes. These are all things that your business may qualify for now that really help, improve your profitability, because you're going to be paying less in taxes, enhance your cash flow. So it's really interesting. And I get a question, I've been getting the question more so now that we're at this remote work from home environment as well. Are there other states, like, we don't necessarily need to be in the state of New Jersey or Pennsylvania or New York. We may have workforce that's looking to relocate. People would like to go to Florida. They'd like to go to, better climate states. What are those states? Are there incentive programs? Are there things that, we might qualify for? So these are more questions coming up. I don't know if you've seen that in your practice area too, Michael, but.
We have, Lee. And what I found interesting is each state, each county is really focused on certain industries. One county may really want manufacturing in their community. Another county may say, we don't want manufacturing, we want higher level technical jobs, software companies, we want them coming into our community. So the incentives will range based on the industry that you're in.
Great. So Ashley, I don't know if we have any questions. Do we have any questions in the poll or anything that you want to maybe definitely doing good on time here. So I don't know if we want to end a little early today, take maybe 10 minutes of Q&A and wrap it up a little bit earlier.
Yep, that sounds good. So a question for you, Lee, is do you have any recommendations on how to best organize a strategic planning session?
Yeah, so it's actually a very good question, and we do get this one often, and there's really no one size fits all response to that. But I think a good starting point would be to look at your last strategic plan, understand, what were the strategic initiatives that you had as part of that, and what were the items that you wanted to accomplish as far as your goals and the various tactics. I also think it's good to start by getting your leadership group together and framing the discussion about, we're going to do a strategic planning exercise and really understanding where the kind of hot buttons are or hot topics. Typically, we're looking at areas such as growth. That's always a key area about sales and growth. And then personnel or your employee base is another area, about culture, about HR related type personnel related issues. And then processes is another key area that typically looking at as far as how we do business. So those are kind of three areas that often the strategic planning revolves around. But yeah, and definitely tap into your advisors as well. We do see benefit of having an outside perspective come in to shed light as far as what other companies and businesses are doing, and also just to frame the discussion in a way where you're very passionate as a business owner and you have a certain perspective or view on things. So to kind of have an independent facilitator often helps.
Okay, great. Michael, this question is for you. For the R&D tax credit, is there a restriction on the types of businesses that may qualify? For example, would an LLC taxed as a partnership qualify?
So thank you for that, Ashley. There are no restrictions in types of entities: C Corp, S Corp, LLC, limited partnership, LLP, sole proprietor. It will always come back to what are you doing in terms of that 4-part test that I mentioned, and what are your expenses. So when we do an initial assessment where we go through a full analysis to see what the potential benefit would mean for you, and we don't bill for that, it gives you and everybody an understanding of what the potential value can mean. And if it's an LLC or a C Corp or S Corp, wherever it is, how it flows to the taxpayer. So it's not based on the type of entity, it's based on the activities and the expenses.
Great. So what is the minimum amount someone would have to spend before it would make sense for them to look at a cost segregation?
So within our firm at Source Advisors, we say it's usually around 400,000 in spend. However, we've done studies for much smaller entities where there was a lot more technical activities happening within the building. So I would say focus more on what the type of activities are, what the business is, not so much on the spend.
Lee, this question is for you. Has anything changed as it relates to succession and exit planning as a result of COVID?
That's a great question. It's interesting. It really depends. What I've seen, it's very specific to the industry that you're in particular as it looks to the M&A and outside third-party sales. There's some industries that are really hot right now where actually the valuation and the multiples are better than they've ever been. And there's many industries that unfortunately are not doing so well. So, but it actually was interesting with a lot of our clients where I think business owners who initially said, I'm going to kind of hold the course, we're going to have this succeed to a family member or succeed to a key leadership ownership group that already exists. COVID kind of helped, like kind of showed the seams a bit for a lot of those clients as far as, their stomach to withheld that, to go through that, because in any type of internal succession, there's going to be bumps in the road. And I think COVID is a major, huge bump in the road for all of us. And unfortunately, it kind of showed the seams as, either those leaders stepped up to the plate and the existing owner says, wow, this is incredible. Like, look how they really rose and shined and excelled in this. And they're very capable to take this business on. And it also indicated for a lot of our business owners, they said, I'm not sure I want to continue to work for the next 5 years in this business. So we've actually had some that I think it's accelerated their succession exit plan. So it's been rather interesting. But, if you go back to when the financial markets had their difficulties in 2009, a lot of business owners put on the shelf retiring because, their wallet was impacted significantly. Unfortunately, here with COVID, it seems like the market's actually gotten back to where it is. So I think it's more now, do I want to continue to weather the storm, the potential future storms that may come up?
Okay. So I don't think we have any more questions. So
Okay.
I think we're good to end.
Great. Well, we wanted to thank everybody again for your participation today, and be on the lookout for future seminars that we have. If you go to our website, Mercadien, there's a lot of materials and articles on a lot of different things that we've talked about. As I'm sure, Michael, your website also has a lot of information on R&D and cost seg and so forth. So definitely go to our websites to take a look at any additional information. And we just wanted to thank everybody, and we will send out a survey evaluation for those that are looking for CPE credit today, Ashley. So I guess once they send that in, they return it, then we'll get them their CPE certificate.
Yep, that's correct.
Perfect.
Great. Well, thank you.
Thank you again. Thank you everyone for joining.
Everybody.